Most traders will struggle to find a setup like this, and that's because there's way more market analysis to be done than they realize. And the first thing they get it wrong is the market's trend. So let's get started. The best way to identify the overall trend is to start analyzing the high time frame price action. Most of the times, high time frames will have a more clean and simple price action, so the trend will be easier to understand. In this case, the swing formations are pretty simple to notice. They're forming an uptrend. On uptrends, what you probably want is to be more inclined to buy the market rather than selling it, and one of the best buying levels on uptrends come from demand levels. As you should know, the demand is the last bearish candle before the market started the impulse to the upside, and this happens on every price structure that follows this kind of action, where it pushes to the upside, pulls back down, then it continues with another push to the upside that breaks above the last high. The demand is found on the swing lows, and you see this pattern multiple times on this market and in this specific time frame. We have 3 demand levels from where 2 did not fill, so the market pulled back higher than the demand level, and one instance where it filled and bounced to the upside from the demand, respecting the theory, and probably some of my viewers found this setup and entered with a buy position. Feel free to tell me in the comment section if you did so. But now let's come back into what's really important, and that's on what continued after this uptrend with these demand levels, and we see that after the last pullback to the upside, the market tried to continue pushing higher, but it didn't manage to break above the last high, because sellers took control and brought the market lower, managing to breaking below the previous low that was made from the last pullback. So this is a bearish price action pattern. Now during bearish price action, the lower high is a pullback to the upside, and this pullback now fills supply levels, which are the last bullish candle before the market started the bearish impulse. If you look closer on this pullback, you will see that it's exactly where it topped on the first supply that has been formed on the highs. It's right there where the market is hit and rejected down. Now this rejection was again formed with an impulse to the downside. The impulse should be followed by a pullback to the upside, pullback that ends on another supply that was formed by the previous downside impulse from the last bullish candle. And you see how it moved right into the supply and rejected back down once again. And pretty much the same thing happened right after. The upcoming pullback ending on a supply that was formed from the last bullish candle before the downside impulse, again rejecting down from the supply. Now this last push also breaks below one of the previous swing lows from the left. This would be an external trend shift. This shows that not only the internal price action is bearish, because from this level the market could still form a higher low from here and take off into an uptrend, but after breaking this swing low, we invalidated this scenario of a possible reversal into an uptrend, and we confirmed a longer-term downtrend. So this recent price action of lower highs and lower lows should still be in play for some more time. Knowing this theory is important because now we look to identify sell setups instead of buy setups. Now there is one more concept we're going to be using. We need to zoom into the last price action. This concept is the imbalance and rebalance of the market. When an impulse is created with very few candles, so a move that is very aggressive to the upside, or in this specific case to the downside, the market leaves an imbalance, and it often tends to pull back into these imbalances. Let's apply the theory. When there is a sequence of 3 candles, we look at the largest candle, that's the impulse, which is the second candle. The first candle is the one previous to the impulsive candle. So this is the first candle. The bearish imbalance happens when the second candle, the largest one, is bearish, and the imbalance in that case is taken from the lower wick of the first candle with the upper wick of the third candle. This entire zone is the bearish imbalance, and we see the market that's right now pulling back to the upside into this imbalance. When it does so, we want to enter into a low time frame so we can see with better accuracy each detail of the price action. Because at some point, the market has a high probability of rejecting back down from this imbalance. Our main goal and interest is to find the moment it will turn bearish again so we can capitalize with a sell setup. We are now on the 1-hour chart. Not that low of a time frame. Usually I would choose the 15 minutes or 5 minutes. However, we are going to use all of them so you understand and see that it can work no matter your time frame choice. The only more important factor is that when you switch into a lower time frame, it just needs to be lower than the one you were before. As an example, we went from the 4-hour chart into this 1-hour one. Now we see that it rejected down from the imbalance. And probably when traders saw this bearish candle, they already started panicking and selling the market. But that doesn't make any sense because if you look at the swing levels, we still see a higher low formation. And now the market is approaching a higher high. It has not done it yet, but we are still bullish until the market breaks into a lower low. And in fact, we did go higher and formed this clean price action of an uptrend. Now we have the first bearish candle that's more aggressive than the recent ones. And if we look closely on the swing levels, it looks like we break below the last low, this forming the trend shift on this 1-hour chart. So it's now when there is a high probability the valid rejection from this imbalance can happen, since the internal price action is showing the first major signs that sellers are starting to take control. To use the theory and put it into practice, we identify a supply, as you should know how to identify supply zones at this point. And the last candle has closed bullish with a wick that's very close to hit the supply, so the market looks like it wants to go there, so we try with a sell short setup. Stop loss above the high of the supply. The take profit should be placed below one of the previous lows, depending on what risk reward you are comfortable with. And the ones that are more confident could target to take down the swing lows, because in theory that's where the market has a quite high probability of going. Sometimes you will see how it respects the downtrend in the short term and takes down one or more of the past lows, but then instead of going lower, it goes higher and basically enters into an uptrend. This is not a problem if you place the take profit on one of the higher levels. This lowers the risk-reward ratio, and sometimes it will go all the way down and you can fully capitalize. Feel free to test and choose what's best for you. In this case, we filled the supply and opened the position. Now it's going our way to the downside, approaching the take profit. And position closing on the take profit. Now if we zoom out, we can see exactly how the market entered into the imbalance, filled the imbalance. And when the trend on the 1-hour chart started to reverse into a downtrend by breaking the past low, that marked the top of the swing pullback from where we capitalized with a sell setup and took the market into downtrend continuation of the 4-hour chart, into a break of the past low. Now this time we're trying lower time frames. Starting on the 1-hour chart, we also have a market following an uptrend pattern, basically pushing to the upside to form the higher high, then pulling back down to form the higher low. From the higher low, the market might leave a demand zone, which should give opportunities to follow the market into breaking past highs. By pushing to the upside, this break of the past high during an uptrend is of course a bullish break of structure. Now after a bullish break of structure, so basically after the past high breaks to the upside, it validates a demand zone, which in this case it did not fill. Because the upcoming pullback to the downside that formed the higher low did not go low enough in order to fill the demand. And you will see this happening quite a lot. In fact, most demand zones won't fill, but you just need few ones that respect. The important factor, however, are the swing levels. And on the lows, we can see how it's holding higher lows, holding the pattern of the uptrend that is then followed with another higher high. So a break of the past high means a new bullish break of structure. This bullish pattern repeats one more time, forming another higher high, another break of structure. Now from the last high, we started gaining bearish pressure, exactly like on the last market, where now it's forming a bearish pattern of lower highs and lower lows. It should not be a problem for most of you to clearly see how each low was higher than the last low, and each high was higher than the last high. But now we start to see lower highs inside this price action, and also lower lows as well, a clear reversal pattern from an uptrend into a downtrend. The reversal is confirming the moment the market breaks below the past low, forming a bearish trend shift on the internal price action. After an internal shift, the market pulls back to the upside, and where does the pullback end? It ends up on a supply from where we get the last bearish reaction, this bearish reaction breaking below the last internal low, so that would be a bearish break of structure. It shouldn't be a problem to clearly see how after marking the last high, the market started a downtrend pattern of lower highs coupled with lower lows, and on the last movement we have the lower low, so I would question what would be the next formation. Logically, if we follow the same pattern, a lower high should be created, so we expect a pullback to the upside. Pullback that might end on a supply and follow bearish continuation, basically breaking the past lows again and again. The supply is identified by looking at the last impulse to the upside, on the last bearish structure. And to be more specific, the supply is the last bullish candle on the most recent bearish structure that caused the impulse to the downside, which is this candle right here, candle that filled the last supply. So in this case, the candle that filled the last supply is now forming the new supply. And since this is not filled yet, we can enter with a sell setup knowing the previous ones have worked out well. The stop loss above the last high and the take profit below the recent low. Basically, what this setup planning says is that we expect a lower high that fills the position and the supply, then followed with a lower low as the take profit target. And as there are many previous lows, we can target each of them, depending of your choice. You might target the first low, or the second one, or the third one, and so on. But since the second one gives a good ratio, I will stick to it for the sake of simplicity. In this case, we filled the supply pretty quick as well, similar to the last ones, and closing on the take profit within a few hours. Breaking below the second target that we've chosen as an exit, those that have chosen the third low are still on the position right now. But if they hit a win, they will get more out of this position. Now what continued is that it pulled back to the upside once again into the supply, but it heavily rejected back down, especially with large bearish candles. Now, those that have chosen the third levels, they closed their positions with a bigger profit, but also now that we got these large bearish candles, we can apply the imbalance theory. If you remember well from the previous market, we look at the sequence of 3 candles, and when we have the bearish candles, we connect the lower wick of the first candle with the upper wick of the third candle. And this entire level is the imbalance area, the bearish imbalance, to be more specific. Now, when the price enters into the imbalance, we get into a lower time frame, exactly like we've done on the last market, but this time it's done on lower time frames. So given the fact that this is the 1-hour chart, we're getting into the 15 minutes. Last time we started from the 4 hours and entered into the 1 hour. So this is the same price, same market, but the price action is seen in more detail being in the 15 minutes chart. Now each time we switch time frames, we need to restart the analysis of the recent price action. What we have is an uptrend pattern in order to fill the imbalance. The uptrend is obviously formed with higher highs and higher low formations, and now on the last move that we can see, it's the push to the upside. Now we have 2 possible outcomes from here. It can push below the past low, forming the trend shift. This would reverse the trend into a downtrend. In this case, we look to identify an opportunity for a sell setup, and on the other outcome, we break above the last high. Just like we did before, this would be a bullish continuation. In this case, we don't look for buys or sells, but we just wait for the market to reverse since we're in a high time frame bearish imbalance. The break happened to the downside, so the bullish break of structure invalidates and the trend shift into a downtrend validates. And now since we have a high, then a lower low, now the expectations would be a lower high from a pullback. And since we know the theory, we capitalize on this lower high by identifying a supply zone near the most recent higher levels. So the supply should be the last bullish candle right before the market gained bearish momentum around these levels. And we capitalize with a sell setup, entry on the supply, stop loss above the high of the supply. And for the take profit, we do exactly like we done on the last market. We target to exit right below the past lows, can be the most recent low, can be the other one from below, or it can also be the last low. That's the swing low from the 1-hour chart. In theory, this should be the target. On the last setup, we skipped it and targeted a higher level. Now let's try this one. The risk-reward ratio is quite high, but these type of setups are not easy to find. You need patience and a lot of analysis. We're still going down. Now it's starting to pull back to the upside. And this finally opened the position. Basically, it filled the supply. Also looking like it's rejecting down right now since the last candle is closing bearish and has covered the last bullish candle. That shows bearish pressure is increasing. And it really is increasing. We're forming a smaller internal downtrend. So as long as it holds, we're fine. And that should be it. This took some time, and it's why I mentioned many times the word patience. You can combine this strategy with the concepts learned from my program, which you can find on the link in the description. We have the only things that actually work and nothing more than that, easily explained so you can skip months or years of trying by yourself.